3 days ago, I stood here and told you Canada's housing market was cracking and Australia was next in line. Well, that's not a forecast anymore. It's confirmed. As of May 31st, Statistics Canada has officially confirmed Canada is in a technical recession. GDP contracted in 3 of the last 4 quarters. And right on cue, exactly on schedule, Australia's national home values just flatlined for the first time in 16 months. Now, that's not a sign that it's completely over, but it's definitely something to pay attention to right now. The 18-year cycle does not care about the political promises. It does not care about soft landing speeches. And the cracks we've been talking about for months are no longer hidden under the floorboards. They're now on the front page. Today, I'll walk you through exactly what just broke in Canada, why Australia is the very next domino, and what the smart money is quietly doing while retail waits for rate cuts. So hit the like button and subscribe to the channel. If you want the full framework on the 18-year cycle, the free 3-part mini course, the link is in the top of the video description. All right, guys, let's get straight into the data as we usually do. On May 29th, Statistics Canada confirmed real GDP contracted at an annualized rate of 0.1% in Q1 2026. That follows a revised reading of -1% in Q4 of 2025. So 2 consecutive negative quarters. That's a textbook definition of a recession. And here's the part that confirms the people in charge of these projections are either useless at their jobs or professional liars. The consensus expectation going in was for growth around positive 1.5%. They were calling for expansion. It printed a contraction. That's a swing of more than 150 basis points in the wrong direction. Now, I know it's close to 0%, but it did go negative while they were looking for a pretty significant positive outlook. Now let's break down what's actually rotting underneath the surface. Residential investment in Canada dropped nearly 8% on an annualized basis in a single quarter. That's driven by a collapse in resale activity and a 9.9% drop in ownership transfer costs. Nobody's buying, nobody's selling, and the house engine has stalled. Business investment fell for the 5th quarter in a row. That's 5 straight quarters. That takes us back to 2024. No reversal, no bounce, just a steady bleed in the productive part of the economy. And here's the one the bulls really don't want to talk about. Government capital investment fell nearly 10% annualized. That's the safety net. That's the spending that was quietly propping up the headline number, and it just got pulled. And it gets worse if we bring this down to the household level. Canada lost 112,000 jobs since the start of 2026. That's the worst start to a year since 2009 outside of the pandemic. Unemployment is sitting at 6.9%. That's the highest in 6 months. And here's where the Bank of Canada gets trapped. The overnight rate is sitting at 2.25%, held steady for 4 straight meetings. They've got a critical decision landing on June 10th, and they're stuck right in the middle. On one side, a recession that's screaming for rate cuts, and on the other side, inflation that just ticked up to 2.8% in April, with gas prices ripping 28.6% higher year over year. So that means that their inflation is now higher than their interest rates, kind of like what happened in Australia recently. That gas spike is obviously coming straight out of the Strait of Hormuz closure and the conflict feeding it. So the central bank can't cut aggressively without pouring fuel on inflation. And they can't hold forever without letting the economy keep sinking. Right now, the market is pricing a 99% chance they hold on June 10th, but that's the classic stagflation trap. Growth falling, prices sticky, and the people in charge frozen in place, basically not doing anything about it. And here's the part nobody on financial TV wants to say out loud. We will here though. They keep calling this a technical recession, as if the word technical softens the blow. Calling it technical doesn't change the GDP print. It's like calling a house fire a technical house thermal event. The number is the number. And Canada, once again, is the leading indicator. Now flip the screen to Australia. People who follow this channel already know how this works. Canada and Australia are mirror image debt bubbles. Both have household debt stacked higher than almost any G7 peer. Both had near identical COVID era property booms. Both leaned on immigration and foreign demand. That's now reversing. Wait for Australia's turn. When Canada cracks, Australia worries it might be the next domino on the table. And it just started to wobble. In May 2026, Australian national home values went flat for the first time since January 2025. The 16-month growth run is over. Let's get specific because the specifics matter now. Sydney is down 0.9% for the month and down 2.1% for the quarter. Melbourne is down 0.8% for the month and down 2.3% for the quarter, but that's no surprise to us. These two markets have been falling for about 5 months straight now. That's where things get a little more interesting. And the engine underneath, the prices is seizing up. Auction clearance rates just hit 54.5%. Trying to get those numbers out because Queensland, I know, is so much lower. We're around 30% here. That's the lowest readings since the COVID lockdowns of April 2020. For context, at the 2021 boom peak, clearance rates were above 80%. Now, barely half of the properties are selling under the hammer. That's practically a buyer's strike. And the supply is piling up at the same time. Sydney listings are now sitting above 13% above the 5-year average. New properties hitting the market are up more than 22% versus the same time last year. Meanwhile, buyer inspection attendance has dropped from 3.5 people per property down to 2.1. So you've got more sellers, fewer buyers, and prices just starting to roll. Now, connect that to the rate machine. The RBA cash rate is sitting at 4.35%. And the RBA that hiked 3 times in 2026 already in February, March, and May. That fully unwound all the rate relief from 2025. Australian borrowers were promised the cuts were coming, and instead they got 3 hikes back to back. And around 1.6 million Australians, roughly 30% of all mortgage holders, are now in mortgage stress. Remember those budget changes we broke down a couple of weeks ago? Negative gearing getting stripped from established properties, the capital gains tax discount getting gutted. That all landed right on top of this. So the transmission mechanism isn't theoretical anymore. It's breaking the Australian consumer in real time. But here's where it gets really interesting, if it wasn't already interesting enough, because there's a massive gap between what retail believes and what the big money is actually doing. So let's take a look at the gap together. The mainstream narrative is built to keep you calm in some instances. Technical recession, soft patch, trade-induced, and already reversing. They'll point to the early estimates that Canadian GDP rebounded 0.4% in April and tell you the worst is behind us. That's the story for retail. Now look at what institutional capital is actually pricing in. Morgan Stanley is forecasting a national property correction in Australia of 5 to 10%, but we know not to trust the big banks on these things. They've described it as potentially the largest decline in 4 decades. So we're saying not to trust them, but this is the information that's going out to retail. And not everyone is, I guess, like us here on the channel. But that's not the number that should scare you. Morgan Stanley also calculated the drop of 15 to 20% is mathematically required just to restore investor returns to where they were before the budget. Not 15 to 20% as a worst case. 15 to 20% just to reset the maths back to break even for property investors. And the smart money isn't waiting around to find out. One of Australia's largest buyer agencies just collapsed this year, citing the budget changes and cooling market. Stranded listings are appearing. Half renovated properties dumped on the market as owners cut their losses. The era of blindly buying property and watching it go up is firmly in the rearview mirror for the select type of property in particular areas, which we will cover in future videos. So here's the divide. Retailers holding on, white-knuckled, praying for rate cuts that may not arrive in 2026. Smart money is already liquidating the most vulnerable real estate and moving to safety. That's the asymmetry that defines every single turn in this cycle. And the soft landing narrative they've sold us, in Canada, it's just officially died. You can't have a soft landing and a recession at the same time. Now, before I bring this all together, this is exactly the stuff the free 3-part mini course is built to explain. Part 1 will walk you through the cycle itself over the last 200 years of data. Part 2 shows you exactly where we are in the cycle right now. And then part 3 is how we're positioning for what comes next. It's completely free, and there's a link in the top of the video description for it. Now, if you've been following the channel, you know we talk a lot about the 18-year cycle, originally documented by Fred Harrison. It's got over 220 years of US public land sale data. Fred Harrison called the 2008 financial crisis years before it happened, and he didn't do it every year leading up to it. He wasn't guessing, he was reading the cycle. The cycle runs roughly 14 years up and 4 years down, and the final stretch of the boom is what we call the winner's curse. We are transitioning right now from stage 5 into stage 6, peak and winner's curse rolling over into the downturn. And the way this resolves follows the same sequence every single time. First, affordability breaks. Second, transaction volumes weaken. Third, prices roll over, and then GDP contracts. Now, there's a few more pieces to that puzzle, in particular to do with construction starts and construction employment, but that goes beyond the scope of today's video. So let's place our two countries on that clock. Canada is already at stage 3 of this sequence. Affordability broke, volume collapsed, prices rolled over, and now GDP is officially contracting. Australia is entering somewhere around stage 2. Affordability is already broken, with Sydney's median sitting above 1.6 million, while borrowers lose power faster than prices fall. Volume is collapsing right now, with clearance rates at COVID lows and listings stacking up. And prices are just beginning to roll, with Sydney and Melbourne both printing negative quarters. That's not a coincidence. Two mirrored debt bubbles hitting the exact same sequence, just one stage apart, right on schedule. And here's what makes this cycle peak so dangerous. Let me tell you, it's not happening in a vacuum. You've got peak leverage colliding with geopolitical inflation shock from the Strait of Hormuz. That's why the central banks are trapped. The Bank of Canada can't cut into recession because energy inflation is sticky. The RBA is hiking into a property downturn for the exact same reason. This is a textbook winner's curse where the last buyers in at the top of the boom get caught with peak prices, peak leverage, and peak rates all at once. We're seeing it with the first home buyers and their 5% deposits through very expensive cities like Sydney and Melbourne and possibly Brisbane coming up soon. Now, I want to be clear about something if I haven't already. Tops are a process, not a single event. I'm not telling you the whole thing collapses tomorrow, next week, next month. This can take many months to fully play out, and I suspect that's what is going to happen. What I'm telling you is the sequence is in motion, and it's confirming exactly what the framework laid out. I'm not giving you my opinion here. I'm just breaking down the maths and the cycles we've seen repeat for over 200 years. Canada's recession is now official policy reality, and the Bank of Canada has just days to respond. Australia's two biggest markets are already printing negative quarters, with volume falling off a cliff. The debt supercycle is slamming into the wall of elevated global rates, and the cracks are no longer hidden. Now it's time to hear from you. After everything we've walked through, here's the question. Does the Bank of Canada panic cut on June 10th and risk reigniting the energy inflation already running hot from the Strait of Hormuz? Or do they hold the line at 2.25% and let the housing market fully capitulate to keep their inflation credibility? I might have gone a bit far with that question, but you get the idea. I want to hear your answers down below. And while you're at it, where does Australia go from here? Drop your call in the comment section. I'll read every one and get back to as many of them as possible. So go back and check previous videos and you'll see the updates in the answers that I've given you there as well. So hit the like button, subscribe to the channel, grab your free 18-year cycle mini course in the top of the video description, and I'll see you guys at the next video. Until then, take care and peace out.